In this video, I'm going to share with you some things that I have on this index card right here. Now you might be saying, well, Jarrad, that's just an index card. I get it, and you're right. But what's on it is more important because it has the potential to save you from losing thousands and thousands of dollars. How would you feel if you lost $100,000 in 1 week? 10% of your money would have just disappeared into thin air, because that's how much money that you would have lost within a week if you had $1 million invested in the stock market at the end of February. As long as you continue to do smart things with your money by investing, then one day you could have at least $1 million investment portfolio. So this isn't an absurd thing to think about. You really need to ask yourself this question though. What would you do and how would you feel if this actually happened to you? Because if you invest for long enough, then this is going to happen multiple times throughout your life. What happened at the end of February 2020 is called a correction. A correction happens when the stock market drops more than 10% but less than 20%. A correction in the stock market doesn't necessarily indicate that we're headed into a bear market. We're considered in a bear market when the stock market drops more than 20% for a longer period of time, usually about 2 months or more. Since 1974, only 4 market corrections have turned into bear markets. While past performance does not necessarily indicate future results, it's still a good thing to know. On average, a stock market correction happens about every 8 to 12 months. So if you're 30 years old right now, then by the time that you reach 70, you're going to see 40 more of these. The last correction that we had was back in December of 2018 when the S&P 500 dropped by 12%, then of course recovered. Now before that, we almost hit correction territory between September of 2018 and October of 2018 when the S&P was down by a little bit over 9%. What I'm basically trying to say is get used to it because it's a normal occurrence when you're investing in the stock market. Hey, I'm Jarrad with an A, and on this channel we talk about all things personal finance, investing. We try to have some fun, and I am also here to talk you off the ledge when things happen like the correction that we saw at the end of February. Think of me like your Uncle Jarrad, who is kind of weird, but he gives you some good advice every now and again. The reason you need to have rules for yourself before problems happen is to save yourself from yourself. It's the same reason that couples who are in their 9th month of pregnancy have everything prepared and planned out for what they're going to do when the baby decides that it's ready to pop out. You want to be proactive as opposed to reactive. Good decisions are more difficult to make if you haven't even thought through as many of the what ifs as you possibly can. When the chaos starts to happen, you're going to forget about most things that you've learned and start making decisions based on fear, which is not good, because fear-based decisions are what will make you lose money faster than you made it. I want to use this video to help prepare you so you don't freak out in the future when this happens again. Alright, let's get into some of the investing rules that I've chosen to put on this index card so I always have a way to reference them and keep me from doing dumb things with my money. Let me know in the comments below what would be some things that you would put on your personal index card, because I'm kind of curious to hear your thoughts and possibly borrow some of your suggestions for my own. If you haven't done it yet, please Hulk smash that thumbs up button. It helps support myself, my dog Molly, and it allows me to make more videos for awesome people just like you. The first thing that I have written on my index card are the words, "See ya in 30 years." Now, this might sound strange to most of you, but it's something that I say to myself every single time that I invest money. The first reason is because I'm a long-term investor. The money that I'm putting in today is for me in 30 years. It's so I can make sure that there's food on the table in the future. Therefore, I'm not losing money right now by putting it into the market. I'm setting it aside for me when I'm 60, 70, and 80 years old. I'm doing old man Jarrad a favor so he can choose whether or not he wants to work in the future. The second reason is more psychological than anything. It's a good way to consistently remind myself of what I'm doing and why I'm doing it. It almost downplays the current events that are happening right now and allows me to feel more comfortable with investing in general. Think about it. In 30 years, when it's the year 2050, I'm probably going to forget about some sickness that the world is dealing with right now. I'll forget about how the market went through a correction in February of 2020, and I'll definitely forget about the presidential election happening later this year. But in 2050, I promise you that I won't forget about the money that I invested this month. That'll have the greatest impact on me than anything going on in the world at this point in time. The next thing that I have on my index card is to consistently invest like you normally do until the market drops by more than 8%. When the market drops by more than 8%, that's when I start to put a little bit more money into it than I normally would. Let me be very clear before I continue. I am not sitting around with a bunch of cash just waiting for it to go down. That's not a smart thing to do. I always have a little bit of cash sitting around, whether it's my emergency fund or right now I have some extra cash because I'm saving up for a rental property. When this has happened in the past, I've used money from my emergency fund. So if I have 6 months worth of an emergency fund, then I might drop it down to 5 months so I can put that extra cash in the market during a correction. Then I would refund my emergency fund to get it back up to the 6 months that I personally prefer. Now at this time, you wouldn't see me let myself go below that 5 months worth of expenses. This has been a good rule for me since it makes me feel like I'm still able to cash in during a correction, but at the same time, I'm not necessarily trying to time the market on a regular basis. The perfect example for this one would be my IRA. I use dollar cost averaging for this account, so every month I contribute $500 so I can max it out every single year. If a correction happens, then I would basically take the $500 that I would have invested in December and invest it today. If the market continued to decline or it happened again at some point throughout the year, then I would take the $500 that I would have invested in November and invest it during the decline, whenever that is, throughout the year. I would continue to take money from my future contributions using the money from my emergency fund. My next rule is don't buy it unless you're gonna hold it forever, aka if you love it so much, then why don't you just marry it? I'm largely a low-cost total stock market fund investor, which by the way is a mouthful. Now this makes my decision a lot easier because I'm not the one out there picking individual stocks for my portfolio. The index fund is taking care of getting rid of the lower performers and replacing them with higher performers. Even though I invest in index funds, it's still helpful for me because I go through the same questioning when deciding which one to purchase. If you are someone that wants to play the game of picking individual stocks, then this will force you to really think before actually purchasing something. With investing, you only lose money when you sell. Always remember that. Money on paper is different from money in your bank account or the cash that you have stuffed in that box of Triscuits in your kitchen. When the market is down, you didn't actually lose money yet. You only lose money when you panic sell because you don't understand the normal cycles that the stock market goes through. This doesn't mean that you shouldn't sell something because the company is going under and liquidating all of their assets, so you just need to salvage what you have left. But it does mean that you need to question why you think that you need to sell your investment. Quick disclaimer, nothing in this video should be taken as investment advice. Do your own research, talk to a professional, don't listen to Uncle Jarrad who just makes videos on YouTube. Understand what you're investing in so you know how it increases and decreases in value. You don't have to know minute details of everything, but you should at least have a broad understanding of what you're investing in so you're more educated. Don't just invest in something because I do. Don't just invest in something because some other YouTuber does. Now, yes, take note of the fact that they do invest in that particular thing, understand why they do, then go do your own research to understand if it possibly makes sense for you. For example, at this point, you'll never see me investing in Bitcoin. Now, did I consider it at one point? Absolutely. I heard about all of the hype just like you and all of these people supposedly making all of this money. I didn't understand it at first, so I needed to take the time to do my own research. Turns out that investing in Bitcoin is just speculation. There's no real way to value Bitcoin because it doesn't have cash flow. It produces absolutely nothing, which makes it nearly impossible to properly value. There's only a finite amount of Bitcoin out there, so when you invest in it, you are speculating that the price will go up. Now, luckily, I took the time to understand this before blindly throwing my money into it just like everybody else. Stay the course, ignore the noise is the next thing on my index card. People are going to talk, news articles will be written, podcasts will be recorded, and videos will be filmed about what's happening in the investment world right now. If you haven't noticed by now, 95% of it is just going to be noise, and the other 5% is actually going to be some valuable information that you shouldn't necessarily react to, but it should still be something that you kind of take note of for yourself. Things like what the Federal Reserve is doing and why they're doing it, how tax cuts are are impacting these large corporations and why these big corporations are buying back so much of their own stock. As long as you're doing the right thing with allocating your investments between stocks, bonds, and other asset classes as you move closer to retirement, then you shouldn't be reacting based on the normal daily and weekly news cycles. Strive to be extremely average when investing in the stock market is the next piece of advice that I have for myself on this index card. If you know anything about me or follow me on Instagram, then you know how much I despise average in every aspect of my life, except when it comes to stock market returns. For me, I'm fine with my returns being the same as the stock market average. I'm not trying to play the game of picking stocks that I hope will outpace the S&P 500. That's why I am a total stock market index fund investor. To be honest with you, this is a very, very boring way to invest. It's extremely difficult to mess up, and by the way, it's also tough to make weekly or monthly YouTube videos updating you on how I put money into the exact same thing this month as I did 3 years ago. Less is more when it comes to how often you're messing with your portfolio and tweaking it. You have less control than you think over how your investments perform over the long run. I've read more than enough financial literature to accept this and stick with index funds. One more thing that I want to mention that isn't on my card, but that I want to bring up. When a sell-off or a correction occurs, that's not the time that you should be asking if this is a good time to start investing. I see a ton of comments about how people want to start investing only because the stock market was going down at the end of February. They say, oh, should I start investing now since the stock market is down? And I'm scratching my head like, what? Why are you asking that question right now? If this got you thinking about investing, then I think that's great. There's nothing wrong with that. But what the market is doing shouldn't dictate whether or not you're investing. Make sure to Hulk smash that thumbs up button and check out the description for more resources and playlists to help you out with all of your personal finance and investing needs. Using some of those resources is also a great way to help support myself and this channel at no extra cost to you. I'll see you in the next one, friends. Adios.